Alright, let's dive into something that's both fascinating and a little counterintuitive. The idea that retirees should actually stay invested in the stock market. I mean, think about it. Traditionally, we've been told that once you retire, it's time to play it safe, right? Shift everything into bonds, maybe some cash, and call it a day. But here's the thing, that advice might actually be outdated. And personally, I think this shift in thinking is one of the most important financial trends retirees need to understand today. What makes this really interesting is the realization that being too conservative with your investments in retirement could actually backfire. I know, it sounds crazy. But if you take a step back and think about it, inflation and longevity are the real silent killers of retirement savings. If your portfolio isn't growing, it's shrinking in real terms. And with people living longer, like, way longer, your money needs to work harder, not just sit there. One thing that immediately stands out is this idea of having 40% to 80% of your portfolio in equities. That's a huge range, right? But here's where it gets nuanced. It's not about being reckless, it's about being intentional. Sherry Belsky from LPL Financial puts it perfectly. It's about giving your portfolio a fighting chance to keep up with your life. And that's a perspective I hadn't really considered before. It's not about taking more risk for the sake of it. It's about ensuring your money doesn't lose its purchasing power over decades. What many people don't realize is that the old rule of thumb, dropping equity exposure to 30% or less in retirement, was based on a different reality. Life expectancies were shorter, and inflation wasn't as much of a concern. But today, with 11,200 Americans turning 65 every single day, the stakes are higher. And here's the kicker, if you're 65 today, there's a good chance you'll live another 30 years. That's not just retirement, that's a second career's worth of time. Your money needs to last. From my perspective, the key here is personalization. There's no one-size-fits-all approach. Stuart Katz talks about growth with guardrails, which I love. It's not about going all in on high-risk stocks, far from it. But it is about having enough growth potential to outpace inflation. And that's where diversification comes in. International stocks, dividend-paying stocks, ETFs, these aren't just buzzwords. They're tools to balance risk and reward. A detail I find fascinating is how advisors are now recommending retirees avoid high-volatility assets like IPOs. Take SpaceX, for example. It's lost over $500 billion in market cap since its IPO. If you're retired and relying on that money, a downturn like that could be devastating. What this really suggests is that volatility isn't just about risk, it's about timing. If you need to pull money out during a downswing, you might never recover. This raises a deeper question. How often should retirees adjust their portfolios? Matt Jensko points out that your allocation shouldn't be set in stone. If your expenses increase, or if you want to leave an inheritance, your strategy needs to evolve. And that's where stress testing comes in. Assuming a 6% or 7% return instead of the double-digit gains we've seen recently, that's smart planning. It's not about being pessimistic, it's about being realistic. What's also worth noting is how this advice changes as you age. Even at 80, advisors suggest keeping 20% to 40% in equities. Zero exposure. That's a recipe for losing purchasing power. Dividend-paying stocks, income ETFs, these become your allies. It's about shifting the focus from growth to income and preservation, but still staying in the game. Now, for those who want simplicity, target date funds are a great option. But here's the catch, not all are created equal. Some drop equity exposure too quickly, which might not align with your needs. Vanguard, for instance, drops to 30% equities 7 years after retirement. If you're planning for 30 years, that might not cut it. So, do your homework. In my opinion, the biggest takeaway here is this: retirement isn't the finish line, it's a new phase. And your investments need to reflect that. It's not about playing it safe, it's about playing it smart. So, if you're retired or planning for it, don't just follow the old rules. Question them. Adapt them. Because the last thing you want is to outlive your savings. And that, my friends, is something worth thinking about.